Welcome to this explainer. Look, if you've spent literally any time online lately, you've probably been absolutely bombarded with chaotic, confusing, and honestly sometimes outright dangerous financial advice. Well, today, we are cutting through all that noise. Consider this your essential, step-by-step starting line. We're going to build a rock-solid foundation, pulling directly from our source material to give you the ultimate day-one map to the trading landscape.
Here's a quick look at our roadmap for today. We'll be going over the basics of trading, trading versus investing, choosing your market, trading strategies explained, and finally, capital and risk management.
All right, part one, the basics of trading. What is it really?
So let's look at the core concept here. Trading is essentially just buying and selling an asset, whether that's a stock, a crypto token, gold, oil, whatever, to capture a profit from the margin in the middle. But here's the critical distinction. Unlike holding physical property or investing for years, in trading, you really don't care about being a long-term owner of the asset. You're purely capitalizing on the movement, the momentum of the prices. Now, obviously, that usually implies buying low and selling high. But wait, what if the market is crashing?
This right here brilliantly illustrates the completely counterintuitive concept of short selling. It proves you can actually make money even when the market crashes. Our source breaks this down perfectly. Imagine an asset is currently priced at 100 rupees, but you know for a fact the price is going to fall. You don't own it, so how do you sell it? Well, you borrow it from your broker. You hit sell, selling that borrowed asset at 100 rupees. Boom. Now you have 100 rupees in your pocket, but you owe the broker that asset by the end of the day. And just as you predicted, the price drops to 95 rupees. So you buy it back at 95, return the asset to the broker, and you get to keep that 5 rupee difference as pure profit. You sold first, bought later, and entirely capitalized on a falling market. Pretty cool, right?
Moving right along to section 2. Trading versus investing, drawing the line.
Okay, this is a huge distinction between these two worlds. If you're learning to trade, you are learning a skill to generate a regular, active business income. It's your daily operation. Investing, like what Warren Buffett does, is completely different. That's about taking existing substantial wealth that you already have sitting around and passively growing it over a long period. In short, trading is when you want to use money to actually make your primary money.
And you really have to respect the environment you're operating in. Our source uses this fantastic pragmatic analogy. Trading is not like buying potatoes or tomatoes at the local market, where you generally know the maximum retail price, right? In financial markets, there is literally no price ceiling. A 1 rupee asset might look incredibly cheap to you, but its actual value could be absolute zero. Prices are driven entirely by global demand and supply. Because of this, success relies entirely on strict technical analysis and probability, not just guessing if something kind of feels cheap.
Section 3. Choosing your market. Where should you trade? The most interesting takeaway here is the process of elimination based on our source material. So there are 4 main markets, but we're going to cross 2 off the list immediately for beginners in India. First up, Forex, trading foreign currencies. You'll see tons of ads for it, but the platform's push to Indian users are largely illegal and unauthorized, bringing a massive risk of your bank account being completely frozen. Just avoid it. Second, commodities, like gold or oil. While these are legal via Indian exchanges, the leverage available to beginners is really poor, making it super hard to generate meaningful returns on a small starting capital. So that leaves us with 2 highly recommended distinct arenas, stocks and crypto.
Let's compare our 2 surviving markets. Notice how stocks beautifully fit a standard day job schedule in India, Monday to Friday, 9:15 a.m. to 3:30 p.m. It's heavily regulated by SEBI, but the leverage is capped at about 5x. On the flip side, crypto offers 24/7 access. That's absolutely perfect if you work or go to college during the day, especially since the best market movements often happen in the evenings. And while crypto itself is decentralized, you can use few registered platforms like Delta Exchange for safety. But here is the real kicker. The leverage in crypto can go up to a staggering 200x. But before you jump headfirst into crypto, we really need to understand the tax situation. Our source highlights this massive tax hack for crypto traders. Listen up. If you buy and sell crypto directly, which is known as spot trading, you get hit with a brutal 30% flat tax on your profits, plus a 1% TDS. And get this, you can't even deduct your losses. It's a huge disadvantage. However, if you trade crypto futures, meaning you're trading contracts based on the price rather than the actual asset itself, that 30% penalty completely vanishes. Normal tax brackets apply, and you actually can offset your losses against your profits. This is exactly why focusing on futures platforms like Delta Exchange is just so much smarter for your bottom line.
Okay, part 4. Trading strategies explained. Basically, your playbook.
In trading, time literally dictates your strategy.
If you hold a trade for just a few minutes, hunting tiny little price movements, you're doing what's called scalping. If you hold a trade for a few hours, but absolutely always close it before the trading day ends, that's intraday trading. And if you have the patience to hold a position for a few days or maybe even weeks to catch a larger market trend, well, that's swing trading. Your choice here ultimately comes down to your personality and, honestly, how much screen time you can commit to each day.
But hey, full stop for a second. This is where we need to draw a hard line for new traders. Our source clearly, and I mean clearly, steers beginners away from two massive danger zones. First up is scalping. Because you're hunting for minute price changes, extreme market manipulation can literally wipe you out, and the brokerage fees on all those high-frequency trades will eat whatever tiny profits you manage to make. The second trap is options trading. Options have a built-in countdown clock called theta decay. Think of it like a rotting piece of fruit. As time passes, the value of the contract literally rots away, and it can drive your investment to absolute zero by the expiry date. For anyone just starting out, the clear, undeniable recommendation is to avoid these traps and stick strictly to intraday or swing trading.
Finally, Section 5, Capital and Risk Management. The fuel.
Let's look at the actual rupees in paise here. If you want to do swing trading in the stock market, you get zero leverage. That means you probably need around 2 lakh rupees to see any meaningful returns for the time you're investing. For intraday stocks, with 5x leverage, 50,000 rupees is a pretty safe starting point. But look at crypto futures. Because of the massive leverage available, you can start generating real, meaningful income with a recommended capital of just 10,000 rupees. You can even test the waters and learn the mechanics of the platform with a mere 100 rupees.
So let's zero in on that staggering 200x leverage number available in crypto futures. What does that actually mean for you? It means your initial 10,000 rupees in capital can instantly, at the click of a button, give you the buying power of a 20 lakh rupee position in the market.
Now, I need you to pause and really hear this. This is the single most important thing you're going to hear today. High leverage is a vicious double-edged sword. Yes, the upside potential is massive. A tiny percentage gain on 20 lakhs yields a huge profit on your 10,000 rupee investment. But, and this is a big but, it equally means the potential for devastating instant losses. If the market moves against you by even a fraction of a percent, your entire 10,000 rupees can be wiped out in the blink of an eye. This power requires absolute respect and strict, completely unemotional analysis if you want to survive.
Which leads us directly to the absolute golden rule of our source material. And I'm delivering this with the utmost seriousness. Never, ever take a loan to trade. If you were trading with money you cannot afford to lose, or worse, money you actively owe to someone else, your psychology will completely break. The second a trade dips into the red, you'll panic, you'll make irrational decisions, and in 99.99% of cases, you will lose everything. If you don't have 10,000 rupees of spare capital, do not borrow it. Get a job, save the money first, and protect your peace of mind. Trading on borrowed money is a guaranteed psychological disaster.
And there you have it. We've stripped away the noise and laid out the foundational facts. You now have the map of the distinct markets available to you, the specific strategies dictated by time, and the very real risks tied to capital and leverage. The tools are right in front of you. So my question to you is this. Based on your schedule, your risk tolerance, and your capital, which path are you going to conquer first? Think on it and get ready to master that chosen strategy next time. Keep learning, stay focused, and I'll catch you in the next explainer.